What is up, everybody? It's your boy Kev here with kind of a different video this time. I made a lecture on options, and I'm calling it Options for Apes. And I wanted to make this, honestly, I know there's a lot of material out there already on the internet about options, but when I started learning options a couple years ago, it was really hard and kind of confusing at first because all the material on the internet already is very conceptual. Or at least it starts off conceptually, and almost like you're in a college lecture, it kind of dives too deep into the technicals and the terms of it. So I kind of dumbed it down a bit. There will still be technical terms and definitions that you will need to know in order to understand options, but to an extent in which that you can use this as a practical overview to get started trading without all of the other bloat. So I kind of reduced it down to a bare minimum. I will, however, assume that you have some familiarity with stock investing and the stock market, basic terminology around that, like bid-ask spread, market orders, limit orders. And if you don't know anything about investing, I highly advise you learn that first before jumping into options, because options can get a little dangerous. So without further ado, in your brokerage account, or if you don't have a brokerage account, you're going to have to apply to even trade options. And back in the day, you had to fill out a PDF or form and actually mail it to your brokerage. Now it's mostly electronic. So within your brokerage, it's usually kind of hidden. So you're going to have to either search in your brokerage search bar or just Google it. Honestly, it's probably easier to kind of figure out how to apply to options. And usually brokerages are going to have like 3 to 4 option levels that you can apply for. And dependent on your personal financial details, your experience with investing or with options, and your goals with that account, they're going to either approve or deny your request for that level. So honestly, when I started, I was 20 years old, was broke, and didn't know anything about options, but I was applying for like the highest options levels. I kind of lied and said, I had, 6 figures, 8 years of options trading experience. So don't lie to that extent. I still got approved, but be reasonable in your lying to get your options level approved. Roth IRAs are limited usually to the lowest level in most brokerages, and some brokerages don't even allow any options trading in your Roth IRA, so keep that in mind. And when you do start applying for those higher options levels, meaning you're going to be trading high option strategies or like advanced option trading, your account's going to automatically become a margin account. I'll kind of get into that later. So how to find options in your favorite stocks and ETFs. In your brokerage, you're going to go to that stock page or whatever page, and you're going to look for an options button, or it might say options chain. Or in this case, it says trade GME options. And in some brokerages, they're going to completely hide it and not have any text. It's going to be like an icon in the corner or at the bottom of the page, or even like super tiny text. So you're going to have to either Google it if you can't find it, or just, keep looking, because it's going to be there, okay? Once you click that, you're going to be most likely led to the options chain page. And the options chain page, I know it looks intimidating, but we're going to go into detail on every single part of this page. But this is what you'll probably see. You're going to see calls on one side, puts on one side, a bunch of dates on the top, colors, green, red, bunch of numbers, a lot of stuff that looks scary, but I promise you it's not as scary as it looks. So the real dumbed down version: buying, and specifically buying options for Apes. Buy a call if you think the price will go up, buy a put if you think the price will go down. And that's pretty much it. Look at that cute monkey with holding a banana. That's all you need to know, or pretty much 50% of what you need to know in order to start trading options. It's that easy. And obviously we're going to go into more detail, but the expiration date is just when that option expires, or how I like to kind of visualize in my mind, by when do I think I'll be right. The strike price, now that's a key term, strike price. Make sure you remember strike price is what price do you think it will be at or will go to. The strike price is kind of like your bet. What price do you bet that this stock or ETF will go to? So let's do an example. Let's buy a call option for GameStop. Let's say it expires July 18th. So that's the date is usually the first thing you're going to look at, because the date's at the top. So I'm going to look at the top, highlighted in green, boom, July 18th, we're good to go. Now I'm buying a call option, so I'm immediately going to look to the left side of this options chain under calls. And I'm looking for a strike price of $32. So I'm going to go to the middle. These are all my strike prices. The current price of GameStop is $29.80 as of May 30th. So that's in between 29 and 30. You're going to see like a color line division. And I'm just going to go lower to 32. Boom. There's my $32 call option left side. And you're going to see a bunch of numbers there. You're going to see the last price it was traded at, the bid, ask, volume. It's open interest, which just means how many call options are open at the moment for this specific option. And then your implied volatility in delta, which we'll go into later. But for now, boom, that's your call option. You could buy it, you could sell it. And pretty much that's saying if you do buy it, you're saying that I bet that GameStop will go to $32 or above by July 18th. Now remember, GameStop is at $29.80. So this is a bullish bet. You're betting that GameStop will increase from $29.80 to whatever. You know, it doesn't have to go to 32. It could even just go to 31, and that option price will increase and you'll make money. Okay. Now let's do a put example. So buying a put. All right. Now let's do a buying a put example. So we're going to do the same strike price, except we're just going to look at the right side of this options chain. Now, this one's a little different just because, you know, it can get confusing. Calls and puts, they're kind of inverse of each other. So the last option we did, and I'll go back one slide, we were betting that GameStop's price was going to increase. This option that we're looking at the $32 strike price is considered out of the money because it's kind of, you know, above what it is right now. That's what it's referred to. It's considered out of the money. And we're going to go over these terms later. So just for now, this is an out of the money call option. If we're buying a put at the same exact strike price, this put will be in the money because a put, right, is pretty much saying I bet that GameStop will be at or below $32 by July 18th. It's a bearish position. And since GameStop's current price is already below $32, hey, we're already right. We're pretty much betting that we'll continue to be right. So that's why this kind of option is considered in the money for put option specifically. Now, it gets a little confusing because puts and calls are inversed. The in the money, out of the money side of the current share price is also inverse. So I split it into 4 quadrants. For calls, just think that the usual bet that you bet something's going to increase when you're buying a call, those are going to be out of the money. You know, they're out of reach and you're trying to reach for it. So they're out of the money. For put, you're betting that the stock price is going to go down. So that means the lower stock prices or the lower strike prices, means they're out of reach for you. You're wanting that price to go down when you buy a put. So those are out of the money puts. And in the money calls or in the money puts means that you're already right. It means that the share price is where you want it compared to the strike price. So for instance, for calls, if GameStop's at $30 and I buy a call for, let's say, $25, I bet that GameStop will go above $25. Well, it's already above $25 because it's at $30. So I'm already right. It's in the money. Same for puts, except the opposite. So it's a key concept to know. It's a key concept to memorize, only for the purpose of understanding what people are saying. Because people will refer to in the money, out of the money all the time, and it gets super confusing if you don't really know what they're talking about. So just remember this quadrant. Go back to the slide, take a picture of the slide, pause the video, do whatever you got to do to get this in your brain. Now, I went over a lot of terms already, and I know it's getting confusing. So boom, here's a slide just of terms that can get confusing. Now, in the world of trading and options, a lot of words are confusing, such as buy and long, sell, right, short. Like these words are interchangeable, and it can get confusing with the word short, especially. So when you sell something, you're also writing an option. You're also shorting an option sometimes. And it gets confusing because short has another definition where, you know, you're betting the price to go down. So be cognizant of the word short and the context in which it is used, because that is like the most confusing word when we're talking about like buying and selling and all that. So for example, long call means someone bought a call. You're buying a call, it's a bullish position. Long put, you're buying a put, it's a bearish position. Same thing with short call, short put, you're selling a call, you're selling a put. And when you sell a call, it's actually the opposite of buying a call. So it's a bearish position. You're actually wanting the price to go down. And when you sell a put, it's the opposite of buying a put. So that's actually a bullish position. Confusing, I know, I just confused a lot of people. But if you just pause the screen and kind of memorize these terms, and it's not a lot, to be honest, you're gonna do great. Okay. Days to expiration, now that's easy. In the money, out of the money, at the money, like we just discussed. These are just the acronyms that are frequently used for that. All right, next, we're gonna talk about option pricing. Now, the price of an option is also referred to as its premium. So you're gonna see those two words interchangeably used. Price, premium, they're the same thing. And going back to a couple slides back, the price of an option, so one option contract represents 100 shares of that stock. So that price has to be multiplied by 100 to get to what you actually have to pay for that option contract. For this example, if you're buying that call option at $32 strike price, the last price it was sold or bought at was $3.05. That means to buy this call option, I'd have to pay $305. Okay, just multiply everything by 100. Forgot to mention that, sorry. But when we're talking about option pricing, you're going to hear online a lot that it's dependent on what's called the Greeks. We're not going to go into each and every single Greek into that much detail, but we are going to talk about these three main variables, two of which are Greeks. So the first one being strike price, or delta. The second one is days to expiration, or time, or theta. And that third variable is implied volatility. And implied volatility is kind of like the craziness of a stock. It's also known as IV. And at the bottom, I kind of put a bonus. Option pricing is based on the Black-Scholes model, kind of a complicated differential equation that you don't need to know at all. It's just there in case you are interested in that stuff. So the first thing we're going to talk about, the strike price or delta of an option, pretty much says the more in the money the strike price is, and that's strike price, the higher the premium, because you have a higher probability of being right. So real quick, looking back at this options chain, the strike price is that in the middle right there. The more in the money the strike price is, the more expensive the option. So for calls, in the money means the strike price is lower because you're already right. GameStop's already at 30. I'm buying at a strike price at 25. It means I'm already right. That means I have to pay a premium or a higher price if I'm already right. Opposite applies for puts. If you're buying a put at a strike price above the current price or more in the money, then you're gonna have to pay more because you're already right. All right, so on this page, two examples. Buying a call on GameStop with a strike price of $5, which is super in the money, means you're saying, I bet GameStop will be at $5 or more by expiry. You're already right, so the call is more expensive, or it has a higher premium. For a put, if you're buying a put on GameStop with a strike price of $5, this is out of the money because out of reach, you're wanting that price to go down when you're buying a put. You're saying, I bet GameStop will go to $5 or less by expiry. GameStop would have to decrease a lot for you to be right. So that's highly unlikely. That's why this put option is cheaper, okay, or has a lower premium. Going back to this chart, I squared off delta. You can actually see delta here. On the call side, at the bottom, it goes from 0.39 all the way to 0.79. And on the put side, it's just inverse and everything's negative. So as it goes more in the money, you'll see delta increase. And delta, that number that you see in the options chain, you can kind of think of it as the probability of being right. That's how I like to picture it. For example, 0.3 delta means you have roughly a 30% chance of being right. It's not an exact like one-to-one exchange, but for practicality purposes, you could totally see delta that way. And I included a normal distribution curve one that you've probably seen in your statistics class in high school or in college, just because when people talk about delta a lot, they refer to standard deviations. And that normal distribution curve, talks about standard deviations a lot. If you remember, like a 95% confidence interval is 1.96 standard deviations away. That z-score, or the number of standard deviations away from the center, is often used in trading. So like one standard deviation out, if you remember, total area under the curve is like 68%, I'm sorry. So the tail of the curve is 16%. So 0.16 delta, or 16% chance of being right, is kind of one standard deviation away from that stock price. It's confusing, but I just threw it in there just so you have something to kind of remember. All right, moving on to days to expiration, or theta. The higher the days till expiration, or the further the expiration date is, means the higher the option price will be, or the higher the premiums. And that kind of makes sense, right? If you have a long expiration, a long dated call or put option, that means you have more time in order for that stock price to move for you to be right. So because you have more time, you're going to have to pay a higher price or a higher premium. The example I used here, I bet that GameStop will go to the moon tomorrow. That's a pretty low probability. I've been saying that for the last 3 years. It's probably not going to happen tomorrow. So I'm going to be paying a low or cheap price for that option, compared to, let's say, I bet that GameStop will go to the moon in the next 100 years. Okay, now that has a high probability of happening because I have so much time for that to be right. So that option I'm buying is going to be more expensive, or it's going to have a higher premium. Now, of note, in bold, this is not a linear function. So it doesn't mean like, every day that passes, the value of that option will decrease in a linear way. It's actually kind of like a curved shape. So what this means, what this curve is here, it says that the closer you get to expiration, the faster the value of that option will decrease. And this graph at the top shows 120 days to 0 days. And the decay, or the theta decay it's called, of that option, where that option price or premium is decreasing, really escalates under 60 days. So boom, once you hit 60 days, you can see that curve starting to ramp down, and that value of the option will go closer and closer to zero until expiration. Now in reality, it's not that like steep of a curve. The bottom chart kind of shows what it actually looks like in reality. For the most part, honestly, from 365 days to 60 days, it's pretty linear. Like the option price will decay similar to a linear regression. Not linear regression, in a linear way. But once you hit like below 60 or 45 days, some people use, that decay will just ramp up. So very key to note, especially when selling options, and we'll get to that later. That next variable that we're going to talk about is implied volatility. Now this is kind of a tricky one because it's hard to kind of visualize. IV is how uncertain or risky people think a stock is. So for example, GameStop, people think that's a meme stock because it's volatile. The price whipsaws up and down. People think it's risky. So inherently it has a higher IV. And here I call it, the crazier the stock price has been, or the greater the uncertainty, the higher the IV, which means the higher the option premiums. Because you're buying an option on such a risky stock, that price, will whipsaw more frequently, which means whatever option you have, you're probably going to be right at some point because that price moves so much. So because you have a higher chance of being right, then you're going to pay a higher premium. Kind of makes sense, right? So more stable stocks like Microsoft, Apple, they're going to have lower premiums in general, just because those stocks don't really move as crazy as GameStop compared to what's called meme stocks. I hate that word, but meme stocks are just super volatile stocks whose price moves a lot. Premiums also get higher before major events. So I listed here before earnings, elections, FOMOC meetings or IPOs, the volatility, or after IPOs, the volatility of a stock is going to be, super elevated, which means premiums are also going to be elevated. Just because there's a lot of uncertainty, you don't know how well earnings are going to react. You don't know who's going to win the election. So people are fearful, they're uncertain. Because of the uncertainty, premiums will go up. And people are usually also making bets during that time. So there's going to be a lot of action in those options. Now, IV crush is a common term used in the community known as when IV contracts or decreases quickly after one of those events. And then because IV decreases, the option premiums decrease also. So what tends to happen, especially in Wall Street bets, is people will buy call options for earnings. Boom, the earnings does well. The price skyrocket or goes up. Hey, they won, right? But the next day they find that their option price or their option decreased in value even though the price went up. It doesn't make any sense. I was right, but I'm still losing money. That's likely because, boom, after earnings, IV decreases because the uncertainty is gone. So that means option prices also decrease. So keep that in mind. Let's do an example using a free website called Option Profit Calculator. You can find it on optionsprofitcalculator.com. But let's see, the returns that we can get when buying or selling options. So let's buy a GameStop call with a strike price of $33 expiring July 18th. So I look up GameStop, boom, hit on the options, go to the date at the top, I hit 18th July. I look on the call side, which is the left side, go all the way down to that $33 strike price, and I see a bid, mid, and ask. I'm just gonna hit on the mid price. I'm gonna hit calculate, and boom, this is what Options Profit Calculator will show me. You can see it shows me pretty much every single day until expiration on July 18th at the end of the chart. And you can see a lot of red. Wow. So when you buy that option, you're going to be all the way on the left side of this chart. Let's say you're right the next day. Boom, GameStop goes all the way up. You're going to make some pretty hefty returns, especially if it goes up really high, really fast, right? You can see returns of up to 100+%. But if you're not right soon enough, that theta decay and possibly IV will decay the value of your option, so that let's say GameStop does go up to $33, but you're holding on to that option until expiration. I highlighted it, or I boxed it in that red dotted box. If GameStop went to $33 and you held that option to around expiration, you're still like down -75%, -100% on your option, which is crazy, right? Because you're right, GameStop went to $33, it went up, but you're still losing money, or that option premium that you bought is going down, which is crazy, right? Because of theta decay. As the expiration gets closer, the value of your option is inherently every single day going down. So be careful with that. Okay, we went through a lot. I'm going to take a break here to see if you're still with me. I'm using that Patrick picture, when he says, it's okay, take your time. There's a video, go back, pause, take a break, watch this later, unsubscribe, dislike my video, do whatever you want. But I just want to make sure that you understood everything up to this point, because after this, we're going to be talking about selling options, which is a lot more complex than buying. So I'm going to move on. Back to this kind of similar slide structure. Selling options for apes. Sell a call if you think the price will go down. Sell a put if you think the price will go up. So it's the exact opposite of buying. And that's pretty much it. That's 50% of selling options. And of course, the expiration date. By when do you think you'll be right? And the strike price. What price do you think it will never be at or go away from? Which is a little different, and you'll get it later once we go further in. So let's do an example. We're going to use the same strike price, except instead of buying a call, we're going to sell a call. You're pretty much saying, I bet that GameStop will be below $32 by July 18th. Now remember, the current price of GameStop is $29.80. So in this case, you're already right. GameStop's already below $32. So that means you're betting that by July 18th, that the price is going to stay where it's at. It's either going to go lower or it's going to go slightly up, but still below $32, and you're still right, which is great. You know, a lot of ways to be right. The price could stay where it's at, could go down, or it could go slightly higher, and you'd still win. So let's sell a put option. Example, same strike price, $32. You're pretty much saying, I bet that GameStop will be above $32 by July 18th. You're selling a put and you're betting that the GameStop will be above $32. It's a bullish position. Now remember, GameStop's at $29.80. So you're betting that the price will increase to 32 or above. Okay. And looking back at the in of the money, out of the money quadrant, nothing changes here. Calls, puts, buying or selling, in the money or out of the money still refers to the same quadrants between calls and puts. So what does selling options actually look like in your brokerage account? It's a super confusing concept because like selling options, I don't have options. Like you're selling something that you're pretty much creating out of thin air. Like you don't have this option. How can you sell it? Well, you can't, okay? Through the magic of the internet, you can click a bunch of internet buttons and sell something that you just created out of thin air. And because you're selling an option, you get paid the premium of that option or the price of that option up front. That's why it's called selling to open. You're still in a position, you're opening a position, but you're selling in this case. So sell to open, you immediately get that money, or what's known as credit, up front in your account. And when people say up front in your account, it means that you get the money and you don't have to like hold it anywhere. You don't have to like keep it anywhere safe. That's yours to use. You can withdraw it. You can enter a different trade. That's yours to keep. You can do whatever you want with it. And your account will show that you have a -1 option position, a -1 put or a -1 call. It's kind of weird how you have a negative option, but that's what it shows when you short or sell or write an option. So you win that premium you win in this trade when the premium or the price of that option decreases. It's the opposite of buying a call. That means remember the 3 variables we talked about? Whenever the strike price moves in your favor, or whenever theta decays, or whenever implied volatility decreases, that option price that you sold will decrease, and that means you secure money. So you can be wrong in both direction and timing and still earn money. And I'll kind of go into that in a couple more slides. So in order to close this position, you do need to rebuy that option. So it's called buying to close, in order to remove that -1 put or call from your account. So that money that you got up front, yes, you kind of do need it if you do want to close that position, because you have to rebuy that option. So you can't just like immediately withdraw the credit that you get, because what if you do need to close it? So you do need to have some cash in case you do need to close your short option position. But if the option price goes down, then you can buy it back at a lower price. Okay. Or if you just do nothing and the option expires worthless or out of the money at expiration, you don't have to do anything. That option will go to zero. That means you gained all that credit. You don't have to buy to close. You don't have to pay money to close that option. That position will automatically close at expiration, and you get to keep that original credit or premium that you received, which is great. It's like you just kind of set it and forget it. Okay. So let's kind of do an example with option profit calculator again. This time, let's sell a GameStop put with a strike price of $25 expiring on July 18th. So I'm back in options profit calculator, hitting 18th of July expiration. Instead of calls, I'm looking at puts. Okay, so I should have moved that line. So looking at the $25 strike, I see a bid price of $1.01, mid price of 106, and 110 ask price. I'm gonna hit that mid price. So I'm selling this $25 strike put option for $1.06. That means I receive $106 when I sell it. Boom, right in my pocket, which is great. So what options profit calculator shows me is pretty much how my returns will look like as the days go by through expiration. Now you can see the price. Let's say, so GameStop's at $29.80 right now. Let's say it goes down to $25, which isn't good. When I'm selling a put option, I want the price to go up. It's a bullish position. I want GameStop's price to go up. But let's say we're wrong. Okay, GameStop goes to $25. At expiration, boom, you can see I still made money. Even if it goes below $25, I'm still making money at expiration. Just because of theta decay. Like, the value of the option goes down regardless of whether you're right, because time goes down. That means you still make money even though you're wrong on direction. Okay? Which is a very powerful thing. You don't make as much money as you do buying options, but hey, you still make money and you don't lose. Okay, so this is what it looks like. You can play around on option profit calculator of different stocks and different options. So I highly advise you do that, because it's a great way to kind of see how option pricing actually looks like when it comes to like how much money you win at the end. So covered calls and cash secured puts. These are selling options. So a covered call means you're selling a call. Cash secured put means you're selling a put. And these are the most common types because they're essentially risk-free. They're super safe, and they're extra ways that you can make income. There's a lot of videos already on the internet about it, so I'm just going to do a quick overview of what actually it looks like. So when you sell options, you get credit up front, but it's not for free. You still have to put something up as collateral. In order to sell a covered call, the covered comes from you already having 100 shares of that stock. So you need 100 shares in order to sell a covered call as collateral. If you have 99 shares, no, you can't sell a covered call. If you have 250, you can only sell 2 covered calls. Okay, so you need that 100 shares per covered call. In order to sell a cash secured put, you need cash, because that's what makes the put cash secured. So how much cash do you need? You need 100 times the strike price of that put in cash as collateral. So in order to sell a $32 strike put on GameStop, you'll need $3,200 cash as collateral. So yes, you get that credit up front and you can do whatever you want with that money, but your 100 shares or your $3,200 in cash is being held as collateral that you can't really touch. When you have a covered call and you have 100 shares, you can't sell those 100 shares while you still have this covered call going, because that would turn that covered call into a naked call, which we'll talk about later. So you do need these prerequisites before you can sell calls or sell puts. All right, so for a covered call, what happens when you're wrong? So remember, when you sell a call, that is a bearish position. You want the price to go down. So if you're wrong, that means the price goes up. It goes above your strike price. We don't want that to happen, but let's say it does. So for a covered call, when you're wrong, that looks like the stock price being at or above your strike price at expiration. Okay? What happens when you're wrong? Don't be afraid. Nothing too bad happens. So your -1 call option will be what's called assigned. That means the 100 shares you had in collateral will be sold at the strike price of your option, regardless of where the current price is. Okay, so if the current price is like way above your strike price, it doesn't matter. You have to sell those 100 shares at the strike price of the option. Okay, if the current price is below your strike price, then you don't get assigned, because you're not wrong. The option expires worthless. Okay, so if you do get assigned, you will receive 100 times the strike price of that option in cash on top of the credit you originally got. So it's like you just sold 100 shares. Nothing too bad happened. It's just you sold 100 shares at that strike price. So it's virtually risk-free. If you plan on holding this stock long term, then it doesn't really matter if you sold, because you still get cash. Like, you shouldn't have lost money, because you're still getting premium when you sold that option anyways. Okay, so that's why this is like one of the go-tos, especially in IRAs or in like normal investing accounts. People sell covered calls just to get extra premium or extra money on top of like normal gains. Okay. All right. So let's go through a covered call example here. So the current price of GameStop as of May 30th, of course, again, $29.80. Let's say I have 300 shares of GameStop to start with. And at this share price, that's equivalent to $8,940. So with those 300 shares, I'm able to sell 3 covered calls. And let's say, so with covered calls, you're always gonna wanna, or you're usually going to sell a covered call with a strike price above the current share price. Just so that if the current price doesn't move, those calls will just expire worthless and you just get to keep the premium. So we'll go through that. So we're selling 3 covered calls at a strike price of $35, expiring July 18th. That's roughly 49 days away from May 30th. And each call is $2.80. So that means we're selling 3. We get 280 per contract. So 280 times 3. We immediately get $840 of credit directly put into our account. And right there, that's like a 9.4% based off the 300 share value of GameStop that I already have. Okay, but that 9.5 or that 9.4% is right now unrealized because technically to close that position, I'd have to buy back those calls at $2.80. Okay, so I get that credit, and if we look to the left, boom, 300 shares that I had still remain in my account, but they're just locked away in those -3 calls as collateral. Okay, so there's 2 scenarios that can happen. After 49 days at expiration, so boom, we skipped 49 days and we're at expiration. There's 2 scenarios. 1, the black box. GameStop stays below $35, which is great. My options are now worthless because GameStop's share price is below 35, and my 3 negative calls expire out of the money and they automatically close at expiration. I don't have to do anything. It just automatically closes. I get to keep the credit, and boom, bam, done. My 300 shares are unlocked. I can do whatever I want with them. So that's great. That's scenario 1. Scenario 2, in 49 days, GameStop share price goes above $35. It can go to 35, it can go to 36, it can go to $100 per share. Doesn't matter, it's just above 35. So now my 3 call options expire in the money and I get what's called assigned. So my 300 shares that I held in collateral are now sold, and I have to sell them at $35 a share because that's the strike price of those covered calls I sold. So if I sell 300 shares at $35, I make $10,500. Okay. So now I have $10,500 plus that original credit I got of $840. Even when I lost, right, I still gain money. It's like a win-win scenario. There's virtually no risk. Yeah, sure, if it goes way above $50, oh man, I could have had 300 shares of GameStop at $50 if I hadn't sold these. Yeah, sure, you could have had more if it went way above $35, but hey, you didn't lose money. You won. Okay, that's the key thing with covered calls. It doesn't matter. You should go into this expecting to be assigned. And if it doesn't go above $35, then hey, you had 300 shares of GameStop anyways, and you were planning on holding it long term, hopefully. So even if GameStop, went down to $30, stayed at $35, like from $30 it went down to like $25, stayed at $30, or went up to maybe $33, that's fine. The options expire worthless. Like, it was as if you held those 300 shares normally, but you just made an additional $840 credit, okay, which is 9.4% in just 49 days, which is, absolutely crazy if you do it on the right stocks. A cash secured put. So a reminder, when you're selling a put or you're selling a cash secured put, that's a bullish position. You want the price to go up. So what happens when you're wrong? The price goes down. So for a cash secured put, when you're wrong at expiration, that stock price is at or below your strike price, right? The price went down. So that means your -1 put option is assigned. In this case, because you had cash as collateral, the cash that you had, or the 100 times the strike price of cash that you had in collateral, will be used to buy 100 shares of that stock at the strike price, regardless of where the current price is. So that's kind of where the dangerous part is. If that current price is way below your strike price, then you're buying 100 shares at not a great deal, right? You're buying 100 shares at that strike price, even though the current price is way lower. But you still receive 100 shares, and you get to keep the premium that you got when you sold that cash secured put in the first place. So it's virtually risk-free if you planned on buying the stock anyways. Like if you want to buy Apple and you want to kind of wait for Apple to go lower, a lot of people just sell cash secured puts at that level they're willing to buy Apple at. And then if they get a sign, who cares? I collect a premium and I bought Apple, which I wanted to do anyways. So that's why it's a great way to enter a position if you are already wanting to get into it. All right, so let's do a cash secured put example. So kind of the same format as the covered call example. So GameStop currently at $29.80 as of May 30th. This time I have $5,000 in cash in my account to start with. Okay, with that $5,000, I can go ahead and sell 2 cash secured puts at a $25 strike price, because 25 times 100 is $2,500. So I can buy 2 of those because I have $5,000 in cash. Okay, so I'm buying 2 cash secured puts, $25 strike, expiring July 18th. This time they're worth $1.06 each contract, so $106 each contract, meaning I get a credit immediately of $212 directly into my account. Right there, that's a 4.24% on my $5,000 in cash. Of course, that 4.24% is unrealized at the moment. So my $5,000 still remains in my account, but they're just locked away in those -2 puts I now have open as collateral. All right, so 49 days pass. I'm at expiration. There's 2 scenarios. Remember, cash secured puts, it's a bullish position. I want the price to go up, okay? GameStop stays above $25. Bam, I won. So if GameStop is above $25, my option expires out of the money. It expires worthless. Those -2 puts get automatically closed and nothing happens. My $5,000 that are locked up are unlocked, and I can do whatever I want with both that $5,000 and with the $212 of credit I got originally. Okay, win. The next scenario is if I'm wrong. So let's say GameStop went below my strike price of $25. The option now expires in the money and I get assigned. So that $5,000 I had in collateral are now used to buy 200 shares because I had 2 cash secured puts. They're used to buy 200 shares at the strike price of $25 a share. All right. So it doesn't matter if the price, is at $25 exactly, or it went super low to maybe like $10. All right. I still have to buy 200 shares of GameStop at $25 a share using that $5,000. So in the end, I'm forced to have 200 shares of GameStop plus that $212 of credit I already had. So if I plan on buying GameStop anyways at the current price of $29.80, it's a win for me because I was able to buy 200 shares of GameStop at now a discount. It's $25 now, and I was okay with buying it at $29.80. So hey, that's great for me, and I get $212 on top of that. So that's kind of why it's a great way to enter positions if you're already planning on holding it. And it's also why it's important whenever you're selling options that you're kind of going into it expecting to be assigned. Okay, you should only be doing these with stocks, with ETFs, with securities that you're willing to hold or you're willing to sell. Okay. Combining these two, I'm sure you've heard the strategy before. This strategy is a very common strategy. It's called the wheel strategy, where you're pretty much cycling through selling cash secured puts and selling covered calls, and then getting assigned, and then or not getting assigned. So I'll go through it with you very quickly because there are so many great videos out there on the wheel strategy. Boom, you sell a cash secured put. Okay, it's a bullish position. You want the price to go up. Best case scenario, the option expires out of the money and the premium decreases to 0, or you know, exit out of that position early, so you buy to close and you make money. Okay, great. Option expires out of the money, you collect all the premium, it expires worthless, boom, your position's closed. You can sell another cash secured put. You can rinse and repeat this circle. Okay, going to the right, let's say you're wrong on a cash secured put. The option expires in the money and then you get assigned. Remember, cash secured put, you get assigned. That means the cash you had in collateral is used to buy 100 shares. Okay, so now you have 100 shares of this stock that you wanted to buy anyways. Great. I have 100 shares. I could sell a covered call now. Boom, you sell a covered call, you collect premium. Let's say the best scenario happens, go to the black, the option expires out of the money, and you keep that premium, or you buy to close it early, and you just keep repeating that cycle until you get assigned, until you're wrong. That option expires in the money and you get assigned. You had 100 shares, but now you have to sell those 100 shares. And because you sold those 100 shares, you get some cash. Boom, you could do a cash secured put again. So that's why it's kind of called the wheel. It's a circle, right? It's a cycle. You just keep doing this, collecting premium on a stock that you want to own anyways. And it's a great way to earn like income or extra money on top of owning a stock. So naked calls and naked puts. I'm not going to go into it. This is just a one slider. Naked implies that you're selling options without that collateral, without the 100 shares, without the 100 times strike price of cash as collateral. So it's a little more risky because you're not covering this short option with anything. So instead of that collateral, you're using what's called margin. And margin is pretty much you're borrowing the brokerage's money in order to put this trade on. It requires a margin account and a higher option trading level. And if you're wrong, margin will be used to either buy 100 shares or be short 100 shares at that strike price instead of like the whole exchange of 100 shares or whatever. I'm not going to go into more detail. You can look up naked calls and naked puts later, but this is just a basic options course, not within the scope. And that's pretty much it. What we went through is pretty much all you need to know about options, buying and selling. But of course, there's still a lot to learn that I might make more lectures or videos in the future. So remember, it's hard at first, and I know it's confusing, but if you keep like drilling through basic terms, kind of reading through the slides very slowly, pausing the video, going back, take as much time as you need to understand it, and then you'll have a moment where boom, it clicks. You'll memorize in the money, out of the money, and then everything will make sense. If you do want this lecture slide, these lecture slides, this PDF, email me, and then I could send it to you. But other than that, I hope this was helpful. I hope it wasn't too complicated, and I hope it wasn't too dumbed down. I hope it was right in the middle, and I hope you learned something from this. So thank you, appreciate it. I'll see you next time.